All right. Hello, everyone. Thank you for joining me today for Lunch and Learn this Friday. Everyone should be on mute right now. And since we only have about 30 minutes to go through our presentation today, what I'm going to do is ask that you stay on mute during my talk. And then I would love it if you email me questions throughout the presentation, and I'll try to have enough time at the end that we can go through and answer any questions that you submit. Okay. So my name is Kristy Hernandez, and I'm the managing attorney for Hernandez Law and Realty. We do a noon Friday lunch and learn almost every week. And today's topic is going to be about what happens after forbearance. What I try to do is bring up really timely topics for these. And at the law firm, this is a question that I am getting from clients every single day. We have a lot of people who have lost their jobs or who are underemployed due to the COVID-19 crisis, who have contacted their lender and gone on forbearance and haven't been making mortgage payments. Many of them have not been making mortgage payments for a year. And they're all wondering what happens to me when my forbearance goes away, because I know I owe my lender and I don't want to lose my house. And so I suspect that you as realtors are all going to get asked this question a lot, and we want you to be knowledgeable. So this is the answer that I'm, as an attorney, telling my clients. What you should first know is that the CARES Act speaks to this. So we just had a revision of the CARES Act that came out last month. And what the main takeaway that I try to impart to clients is that there's a really big difference between when the government is involved in your mortgage and when it is not. So here in America, right, we believe in the freedom of private industry. And so the government has the most ability to make changes to loans that the government is involved in. So where the CARES Act helps out homeowners is for government-backed loans. So if your client has an FHA loan, a USDA loan, a VA loan, a Fannie or Freddie loan, they have the most opportunity to get help after COVID. What you should understand is that the CARES Act recognizes people who received income insufficiency because of the COVID crisis. So there's a limited period of time where you can be behind and have a CARES Act forbearance recognized. So if you were somebody that was already behind in your mortgage in 2019, before COVID hit, this does not apply to you. This is people who, because of COVID, lost income. And so what happens according to the CARES Act is the government has made a special pathway for people to get current if you have a government-backed loan. So let's say that this wasn't COVID times and you had a normal forbearance because maybe you lost your job. Well, the way that forbearance typically works is you get a few months off of paying your mortgage. But as soon as that forbearance is up, you got to get current again. What the CARES Act says is that what we're going to do is we are going to allow a deferment. What they're going to do is it simply create like a little junior mortgage where all of the arrears that people have accumulated while they're on their COVID forbearance get tacked on to the back end of the loan. And they get to pay that amount off when they refinance or they later sell their house. Okay, this is the most common thing that the government is going to try to do for people, but only if you have a government-backed loan. There is a really helpful fact sheet that was put out by the FHA that talks about these programs. There are also opportunities to just get current if you have the money, to enter a repayment plan with the government if you have the money. But most people just don't have that big pop of cash that's going to allow them to be able to get current. So the government is going to provide that big deferral at the end, okay? So for those of you who are working with homeowners who know they have a government-backed loan, there is good opportunity for them to be current. What I want to really hone in on today is the customers that you're going to be interacting with, those homeowners that do not have a government-backed loan. And almost all jumbo loans are not federally guaranteed. And so if you are a realtor in the Bay Area, most of your loans out there, most of your clients are going to be in jumbo loan programs that don't have this government security. And we want to know what to tell these people. So Um, for folks that have a conventional loan that has no government backing, no government guarantee, there are 5 common things that lenders can do for homeowners. But what I want you to understand about conventional loans is think about it, it's like the Wild West, okay? This is not like the Obama loan mod programs where there was set government help that was being provided to the banks so that they could pass that on to the lender. The CARES Act right now, it only covers government-backed loans. So when the forbearances expire that all conventional loans have been offering to their homeowners, well, it's up to the individual lender to decide what are they going to do for people. And so there is no gold standard right now as what I, as an attorney, can promise my conventional loan homeowners. So what I'm doing is I'm saying, well, here's sort of the options that are often available to you. So one thing the lender will always let you do is full repayment, right? So option one, if you've got a pool of cash, you can bring it current, right? And they'll give you a payoff balance and you just write a check. Sometimes if people have access to 401k funds or family that can help them out, that's feasible. But for most of the people that I'm interacting with, there's just no pool of cash that they can tap into for full repayment. Okay, option two, almost every lender will allow for an up to 12-month repayment plan. I personally think these are horrible. What you all should know about repayment plans is that a repayment plan involves a homeowner starting to make their normal payment again, right? So if your mortgage was $3,000 a month, you're paying $3,000 a month. But then they take all of the arrears and they divide it by 12 months and you pay that in addition to your normal mortgage payment. So, oh my gosh, if you're 12,000 behind, right? And most people are more than 12,000 behind, now your mortgage is 3,000 plus an extra repayment of another 1,000. So if you've already been struggling from income insufficiency or like zero income, what we're talking about is like a real mountain to climb on these repayment plans, especially if you're behind, if your payment's 3,000 a month and you missed an entire year's worth of payment. We find that most repayment plans are not practical because the banks typically will not offer longer than 12 months. But if you have a really strong income earner homeowner, that's a possibility. And the banks will pretty much always approve that. They like that because you're getting current quickly. Okay, option three, they can lengthen the loan. So let's say, for example, you have missed 12 months of payments. What they will do is they will sometimes add on another 12 months of payments at the end of the loan. Okay, this is different than a deferral. Okay, a deferral is option four. Deferral is when you take all of the arrears and you sort of put it in a box at the end of the loan and you say, okay, the day you sell your house, the day that you refinance, you pay off that in one big chunk. So it's kind of like a repayment plan of the arrears, but it's at the way end of the loan. The lengthening of the loan is just saying we're going to give you an extra 12 months. So normally if you had a 30-year loan, your loan is now 30 years plus 12 months, right? So you have a 31-year loan now, and they've extended that term out so that if you're somebody who you want to keep this house and you don't want to have to refinance, the lengthening of the loan is kind of a cool option. I am not seeing a lot of lenders do this, but it is in the bevy of options. If you're talking to your homeowner about what to ask for, this is something that I would encourage them to ask for. It's a good option. And so then we talked about deferral. That's the big chunk that's paid all at the end of the loan. And then lastly, option five, loan modification. Most of the homeowners that I am talking to right now, they're really interested in loan mod, right? Because they're familiar with this term. Back in like 2008 to 2012, a lot of these people actually got modifications on their loans. They kind of know about it. And what they understand is that it may be some combination of reducing the interest rate, lengthening the loan, balloon payment or deferral at the end of the loan. They really get it. I want to talk about why I don't think loan mods are practical in this environment. I am really worried for all of these homeowners with conventional loans who are coming to my office and saying, oh, Kristy, get me a loan mod, right? I got one before and that's what I want to happen. And they come in with a lot of certainty that that's going to be available to them. And so I'm trying to do a lot of education about this problem because remember back in '08 to 2012, when all these loan mods were just really available to homeowners. During that time, we had a really low market price point, right? Properties were worth, just worth nothing and everybody was underwater. Banks like to give loan mods when they are going to lose money. Okay, so they go, ooh, we have a lot of incentive. If we don't help this person, they're going to lose their home to foreclosure. And if this home goes to foreclosure in a down market, we are going to take a loss. Banks are for stockholders, not homeowners. Okay. And so the bank is going to do the thing that makes their stockholders the most money. That is not just what good business is, right? That's their mandate. They have a duty to stockholders to make money. And so what we're looking at right now is a booming market, really, really big prices where your average homeowner has equity. I've helped one homeowner with a short sale in the last 12 months, right? Back then, everything was a short sale, right? We're just in a super different market than we were dealing with at the time that loan mods were a good thing. So what happens is when a bank can foreclose and they can get paid in full, foreclosure is awesome for the bank, right? When a bank forecloses and there's lots of value in a home and there's lots of equity, well, not only do they get paid back every penny that they're owed, they get paid back quickly, right? The California non-judicial foreclosure process takes only 4 months. So once the moratorium on foreclosure lifts, right, now within 4 months, they can foreclose and get paid back every penny that's owed. And also, they're allowed to get reimbursed their cost of foreclosure. So they're not even out attorney's fees because they're going to take the cost of those foreclosure out of what they get paid at the foreclosure auction. And so we're looking at an environment right now where banks are not particularly incentivized to work with homeowners. And this scares me a lot because we have homeowners that are coming into my office with the assumption that, oh, CARES Act helps me, right? Oh, they're going to have to give me a loan mod or we're going to have to get a deferment. And if you have a government-backed loan, oh yes, the government has absolutely interceded and created a wonderful law that is likely to protect you and give you good options. But if you are in a conventional mortgage, the bank is not incentivized to help you. So with that being said, I am seeing some homeowners with equity get approved for loan mods. But the quality of these mods are not particularly good. One thing that clients are really excited about is, let's say they got a loan mod back in 2012, and they had one of the step-up loan mods that were common at that time, where they started out at like a 2% interest, and then it went up to 3%, and then it went up to 4%, and then it capped at 5%. Some of these folks are in like a 4 to 5% interest rate right now, and they're thinking, woohoo, if my bank gives me a loan mod, maybe now I'll get the good rates that are currently available to people who can refinance. And so they get real excited. Kristy, I want you to save me money because I'm going to get a loan mod and I want you to drop my interest rate down to 2.85%. And the bank has no incentive to do this, right? The bank makes more money keeping you at the interest rate that you have. And the bank makes more money foreclosing on you and just recouping their investment. So for folks that are getting loan mods, the quality of the loan mod typically is you stay at exactly the same interest rate. I've had a couple homeowners where the interest rate has actually gone up. They've raised it on them because they're saying, we're doing you a favor. And so if you want to modify your terms, we're going to have a better quality loan for us, not for you. And then typically what we're seeing is some kind of deferment or balloon payment where the arrears get tacked onto the end. But the loan mods that are available to folks today are not the miracle great house saving loan mods that were available back to people back in '08 to 2012. It's going to be really interesting over the course of the next 6 months as forbearance, it starts to be more and more forbearances start to expire. Because what we see right now is legislation that has affected government-backed loans, but the government has not yet interceded in any kind of like Obama-style loan mod program to help conventional mortgages. Banks act when they are incentivized financially to act, Okay, that's sort of rule one of, running a business. We have to make money. And so what happens is if the government acts, what they will likely do is some kind of program where they are giving banks financial incentive to approve people for loan mod. So like back in the Obama days, banks would get like $1,500 from the federal government every time they approved somebody for a mod. Without some kind of legislation or government intervention of that style, I suspect that we are going to start seeing more and more foreclosures for folks in conventional loans where there is no program available. So what I want you to understand is that for people who are getting their jobs back, right, where they have gone back to work and they are now back in an income stable position, people who have income stability have the most options, right? Isn't that how it always is, right? If you are financially sound, there's just more that's available to you. You may be able to take advantage of a repayment plan. A lot of clients right now are coming to me and asking me about refinance. So maybe I'm in a conventional loan and I've missed some payments. Can I refinance? I want to spend a little time focusing on this. Typically, if you, prior to COVID, were a person who had to take a forbearance for some reason, right? Maybe you lost your job. What would happen is, in order to refinance, you would have to prove 12 consistent months of timely payments before a lender would approve you for refinance after your forbearance expired. So you would have to reestablish a year of really good on-time credit history in order to be eligible for refinance in a non-COVID world. Okay, one of the things that the CARES Act says is that if somebody has a COVID-related financial decline that has caused them to need a forbearance, well, then we are not supposed to have any negative credit impacting during those forbearance months due to COVID. And what they are saying is that they are recommending an industry standard for lending where if you can show 3 good months of payments after your forbearance ends, then they are recommending that lending guidelines be that you can get approved for a refinance with only 3 months of good payment history, not 12. The problem is that the government can intercede in government loans, right? So if you're getting a VA loan, you absolutely know that the government is going to honor that standard, okay? But we cannot control conventional mortgages without legislation. So we don't know if those refinance guidelines that have been set up for government loans are going to be adopted in private industry. We hope so, but refinance is not a guarantee for folks at this time. And so we're hoping that the industry does adopt that standard for refinance. But the big thing about refinance is that you have to qualify. So just like if you were refinancing and you never went behind, you have to prove that you have income sufficiency in order to afford the payment. Most lenders require you have that your income, your mortgage payment be no more than 31 to 35% of your gross income. So for example, if your income is $10,000 a month, you can afford a mortgage payment of somewhere between 31 and 3,500. Okay, that is for refinance, and that is also for loan mod. If you are somebody who has lost your job due to COVID, you may not have bounced back with your income. Maybe you're getting part-time hours right now, or maybe you're just getting unemployment and you have a little bit of money coming in, but you're not back at work full-time. A lot of these options like refinance and loan modification and repayment plan require that you have your income back on point again. And if you don't have your income back on point again, you are not going to be approved, because even if you have a very good reason for having gone behind and you're likely to get your job in the future, the banks require income proof now at the time that we need it most. So these options are not on the table for people who are still suffering from job loss and income insufficiency and haven't got back at their pre-COVID income levels. So one of the things that is the most difficult homeowner situation that I'm dealing with right now is somebody who's already had 12 months of forbearance. What you should know is that when the first CARES Act came out, it was originally offering 12 months of forbearance, period. At the end of 12 months, you were out. This second CARES Act that just came out last month, they extended the amount of time that they were going to give people in a COVID forbearance. So when it comes to government loans, you're now looking at an additional 6 months. So 18 total months is what is now approved for all government-backed loans. For conventional loans, they're mandating 3 more months. So 15 months total of forbearance for conventional loans. But that's it, right? Unless there is some more government legislation, once you have hit your 15 or 18 months, you now are no longer eligible for forbearance. My prediction as an attorney, I specialize in distressed property. These are my people. My prediction is that we are about to see a wave of homeowners who are going to come out of forbearance, have no more months left, and who still have income insufficiency. And they're going to be reaching out to realtors like you guys saying, what do we do? And there are not great options available for people who have not rebounded financially. And so I suspect that you guys are going to end up doing a lot of these distress listings to help prevent foreclosure. In the future, I'll probably be offering some talks about foreclosure for those of you who want to get educated, who maybe haven't dealt with foreclosure issues since maybe 2008. We're going to really want to be up to speed on the timelines of foreclosures and what all the notices are. Start educating yourselves now. Most of the COVID forbearances, the last day to apply for a COVID forbearance is June 30th, 2021. If you have not applied for a COVID forbearance by then, you are outside of the COVID timetable and you are not going to ever get a COVID related forbearance. You might be able to ask for like a traditional forbearance, but then it would have credit impact and it would not be like eligible for some of these government programs. So, you guys, I know this is kind of a down talk, right? I'm a little bit negative about all this because I'm really worried about these homeowners and where the market is going. And so I really feel like right now we're at such a high in the market because there is not much that is being put out as far as homeowners are really safe right now. They're protected from foreclosure, even if they're not making their payments. And so they have very little incentive to put their home on the market for sale. I suspect as these forbearances start ending, we're going to really start seeing a lot more homes hitting the market. The inventory is going to be bigger because people just don't have other options. And so for us as realtors, that's good for us. But I always feel like the best way that we can serve our clients is to have a great knowledge base for all the options that are available to them to save their home. And then you're their realtor for life, right? Because they go, God, they did everything to teach me all the ways that I possibly could to protect my house and to try to save it. And when I, at my last resort, had to put it on the market, they were just a killer realtor who got me the best price that I could. But I always felt like they fought for me. And so I hope that this talk gives you guys some interesting information about what options are available so you can have those knowledge kind of at your fingertips when you're dealing with people going through this situation. If you haven't met anybody going through this yet, I expect you will very soon. Okay, so that's kind of the end of my prepared talk. Does anybody have any questions for me? Anything that they would like to go over?
Hey, Kristy, just a quick question. I'm assuming that second loans are not, if someone's behind in their second loans, none of those are going to be government owned, correct?
Yeah. I mean, that's a really smart question because we're really talking about first mortgages here. And so second mortgages are kind of off the table. The other thing that I'm seeing a lot of phone calls about that is not really prevalent in the news is for people who have rental properties or second homes. Maybe they have a vacation home. None of the CARES Act provisions help people. This is primary residence related, right? So all of these weird, second mortgages, cash out refinance loans that people are struggling to pay, vacation homes, rental properties, they're given some protection under the CARES Act if your tenant is not paying you and that's the reason you can't afford your mortgage. But for the most part, all of these like sort of extraneous non-primary residence properties and main mortgages, we're not getting help for those either. And so a lot of those like rental homes and vacation homes, I'm sure they will be like the first wave of properties to hit the market.
Okay, cool. Thank you.
Yeah. Does anybody else have any questions for me before we end our time? Okay, I'm not seeing any messages come
I have
over.
a question.
Yes, please.
Do you have any idea as far as the number of foreclosures that we can expect to see in the next, I don't know, year or maybe?
Oh, one thing that is great, right, is that we are dealing with a market where folks have equity. In my opinion, we should not be seeing foreclosures. We should be seeing listings, right? People should be cashing out of these properties if they can't afford them. And so I suspect people, just aren't educated, and there will be more foreclosures. This is a really good time if you're considering doing some kind of NOD or foreclosure marketing, to kind of keep your eye on that as a realtor. I think there's opportunity there for you to reach people, but I don't think there's any way to know for sure. That's something that if you want to get on my newsletter, I often do some updates on what's going on in distressed property. If you shoot me a little email, or you like my Facebook page, or send a message through the law firm Facebook page, I can add you to that. And we often do stats about that in both the Bay Area and Sacramento markets to kind of keep our clients up to speed.
Hey,
Also,
Chris.
something,
Oh, go ahead.
just really quick, something that will affect that, of course, also is if legislation, comes about that affects this issue. Are there going to be loan mods that become available that incentivize lenders to, give people loan mods, right? Any kind of law that helps homeowners in this category of conventional loans would obviously drop the amount of foreclosures that we're having.
So I just wanted to say one thing, Trinidad, just keep something in mind. A lot of realtors will use the word foreclosure, but there is a difference between pre-foreclosure and foreclosure. So a pre-foreclosure just means, think of it this way, as someone that has filed the bank's filed an NOD on the homeowner, and because they're far behind on their payments, the home hasn't foreclosed yet, but it's on its way. And then because a lot of people use the word foreclosure just because people are in foreclosure. And, that's just a wording issue. But once the house gets foreclosed on and it's sold either to a third party or it goes back to the bank, then that's called a REO. Well, that's another term that we'll use. So foreclosure, but really if you think of it pre-foreclosure and then REO, then I think you can stay on track with that.
One thing I want to point out too, as you start taking properties where the people have been in financial distress, I want to encourage you to get a preliminary title report very, very early on. A lot of these people are going to have been sued for credit card debt, and they're going to have judgment liens on the property. And you want to know about these early. One of the things that I spend a lot of time doing is negotiating judgment liens before a property goes on the market. Once you open an escrow and title company puts out a demand to the creditor for payoff balance of a judgment lien, like a credit card, they will not settle, right? But if we know what liens exist and we negotiate them before the property even goes on the market, the average lien settles for about 50% of the balance owed. So we can often get our homeowners a lot more cash in pocket if we're dealing with all of these little problems before the property goes. Once they're in foreclosure, you may not have time for that, but this is like best practices as you're dealing with distressed properties. Start thinking about being proactive on any kind of liens and debts, because foreclosure is usually the house is the last thing they stop paying for. There's many, many other things that they've stopped paying for that can result in liens against the home by the time the house is what starts to go. So just food for thought for you guys. If you have questions like this, I do free consultation for realtors. If you want to call and, kind of pitch me the problem that's going on with your property, I'll take your call or shoot me an email and we can go over it. But I suspect you guys are about to be a lot busier in this distressed market. And, if you have weird issues come up and you're not sure how, please consider contacting the law firm. I'd love to work with you and your clients about it. And we'll probably be doing some more talks on distressed property over the next couple of weeks. Next Friday, we're skipping. We're not having a meeting next Friday. I'm getting remarried next Friday. So I'm giving myself a day off to do that. But we'll pick another topic and I'll be back 2 weeks from now. And if anybody has a topic that they'd like me to speak to, that they feel is timely in the market, please email me. We want it to be meaningful for you so you get something out of it. And of course, you guys are always welcome to join our SAC Intero Lunch and Learns. If you have questions about Intero and you're not a part of it and you want to learn more, reach out to me for that. We'd love to talk to you about our brand and how we can engage with you. So thank you all very much for attending. And
Oh,
I
wait,
think
you're getting married? Did you say that you're getting married?
I'm getting remarried. I'm trying it again.
Congratulations.
Thank you. So we'll see you in 2 weeks, and we're right on time at 30 minutes. So hopefully that was meaningful to you guys. And I look forward to seeing you 2 weeks from now for our next talk. All right. Thank you, everyone.
Kristy.
Congratulations. Bye-bye.
Thank you.